I brought with me my favorite book on investing. I'm going to use it a couple of times tonight. It's called Winning the Loser's Game. Winning the Loser's Game by Charles Ellis. It's out about a year ago in its 6th edition. The book was first written, I think, back in 1976. Over 500,000 copies of the book have been sold. I just stumbled across the book. I read an article in a newspaper about it, and I thought that sounded like a book would be interesting, and it is. And it talks a lot, has one chapter in this book that really, again, was an eye-opener for me. I'm a simple guy. I get awed and impressed by little things. But he talked about in this book the mistake that we all make as we get older with our money, okay? We start to make investment decisions based upon our own expected mortality, okay? You're retired, you're not working any longer, you're on a fixed income, and so you become very guarded about your money, and you don't expose it to risk. Well, try as hard as they may, the folks here at San Diego County Credit Union, just like everybody else, they can't pay you very much interest on your CDs, okay? If you're lucky, you're gonna pull down 1.5%, 2%, something like that, okay? And after taxes and inflation, you're probably losing ground. You probably are losing ground. So it puts you into this situation. You're on a fixed income. You can't tolerate that low rate of interest. Sure, you did get a big bump up this year in your Social Security, didn't you? That comes in very handy. Really helpful. And so you're caught between a rock and a hard spot. What do you do? What do you do? Well, most people kind of just bear it out. But we've had 5-6 years now of extremely low interest rates, and I personally think we're going to stay that way for quite a while. In the book, what Ellis says, he says, is the mistake that we make is that we make those decisions based upon our own expected mortality instead of the life expectancy of the people that we want to leave the money to. Okay, think about that for a second. In my own case, with my wife and I, our two children have pretty much sucked us dry for all they're going to get. Okay, so it's reached that point. Okay, so now we focus all of our attention on our 4 grandchildren. Okay, 2 of them as I mentioned, Sophia will turn 11 on Thursday. Our grandson will turn 11 in June, and then we have a 7-year-old, and then we have a brand new grandson up in 3 of them live up in the Seattle area. So if we're making investment decisions now for them, we're talking about a life expectancy of 80 to 90 years. A baby born today has a 50-50 chance of living to be 100. So for the money that we're going to invest for them over the long term, we're willing to expose that to the stock market and to the rewards and risk that come with that. It's not a big stretch for us. I say this all the time. People, I find it kind of fun. I'm 100% invested in the stock market. I always will. I will die 100% invested in the stock market. For me, it's just very comfortable, and I don't worry about the ups and downs in the market. I don't worry about what happens on a day-to-day basis. That's the worst thing you could possibly do. And I just kind of do my best to own good investments and kind of let them do their own thing over time. My wife and I have like 6 core stock holdings in our portfolio. And even though I spend every day 8 to 10 hours a day watching the markets and stuff that are going on, if somebody were to ask me to tell them the price of these 6 or 7 stocks, I couldn't do it. I couldn't do it because I don't care. I don't care. Okay, those stocks are going to be around a long time after I'm gone, and that's the kind of peace of mind that they provide. By the way, I'm not crazy. Well, I may be crazy, but I'm investing in those stocks not so much because I worry about them going up and down in value. These are all stocks that pay very good dividends. They pay dividends that are increased year after year after year after year. That's the real benefit of the companies we own. We like companies that are dividend payers and raise their dividend. You take a look at your CDs and bonds and things like that, you're not going to see your income go up over time. But with these companies that pay dividends and raise their dividends, it raises your income every year. So it's really neat. So I like to really kind of preach about all of that. But it's a challenging time, and I don't expect everybody in this room to be as excited about stocks as I am. There are people in this room that if you extend the maturity on your CDs from 3 months to 6 months, you think you've made a tremendous leap of faith. You don't sleep for weeks, and you're just tied up in a knot all the time. And then there are other people in the room that say, hey, Chamberlin, the bus for Viejas leaves at 7:30, so let's keep it moving, okay? Everybody has a different tolerance for risk. You make your decisions based upon that.